Headlines suggest a cooling in global friction, but the latest shipping and credit data are starting to tell a different story, one that isn't showing up in the main news cycle yet. The market's technical landscape is shifting, creating a sharp divide between headlines and reality. Benjamin Cowen notes that the S&P 500 has officially entered a 5% correction. In the tech sector, Nana reports that institutional money appeared to sell into the retail enthusiasm following NVIDIA's GTC keynote. This disconnect is most visible in energy. Despite optimistic statements from the Treasury, Nana highlights that shipping volumes in the Strait of Hormuz has a critical lows. The technical landscape is shifting. Benjamin Cowen reports that the S&P 500 has officially entered a correction, dropping 5% from its recent highs. We're seeing a similar pattern in tech. Nana highlights that institutional money appeared to sell into the retail enthusiasm surrounding the NVIDIA GTC keynote. It suggests a sell-the-news reaction is taking hold as the broader market searches for a bottom. There's a growing gap between official headlines and what's actually happening at sea. On March 14th, shipping traffic through the Strait of Hormuz actually dropped to zero, which is a far cry from the optimistic narrative we're hearing out of the Treasury. This friction is why JP Morgan is warning that if oil stays above $90, the S&P 500 could face a further 10 to 15% slide. As 42 Macro points out, this isn't just about energy. The conflict is actively draining global liquidity, making it a very risky time to try and buy the dip. While official headlines suggest that global tensions are cooling, the physical data from the water tells a much different story. Nana highlights a critical disconnect from March 14th, when the number of ships passing through the Strait of Hormuz actually dropped to zero. This total halt in traffic directly challenges the easing narrative coming out of Washington and signals that energy supply risks are far from resolved. Behind the excitement over AI chips, a credit story is emerging that looks a lot like the pre-2008 mortgage bubble. Eurodollar University is highlighting a warning from the Bank for International Settlements about shadow borrowing, where companies use off-balance sheet vehicles to fund large-scale infrastructure. This credit shift is the real catalyst to watch. As a consequence, we're seeing defensive moves like Meta's reported plan to cut over 20% of its workforce to conserve cash. When you factor in Meta's $30 billion debt arrangement with Blue Owl Capital, it's clear the cost of building the AI future is getting much heavier. Beyond the chip hype, Eurodollar University is highlighting a warning from the Bank for International Settlements regarding shadow borrowing. They're seeing AI infrastructure funded through off-balance sheet vehicles, a practice reminiscent of the hidden leverage that preceded the 2008 mortgage bubble. They cite Meta's $30 billion debt arrangement with Blue Owl Capital as a prime example of how this debt is being tucked away, potentially creating the kind of systemic risk that traditional accounting misses. Take Meta as a case study. The company is reportedly planning to cut over 20% of its workforce. While some attribute this to AI efficiency, Eurodollar University views it as a defensive shift to conserve cash. They point to Meta's $30 billion off-balance sheet debt arrangement with Blue Owl Capital as evidence. It's a clear sign that the financial weight of building the AI future is getting much heavier. Heresy Financial argues that the 99% consensus for holding rates ignores a softening labor market where unemployment has reached 4.4%. Meanwhile, Benjamin Cowen notes that initial jobless claims are still low at 213,000. In his view, the labor market hasn't broken enough to trigger an immediate recession, leaving the Fed caught between sticky energy costs and cooling employment data. Economics Explained is highlighting how the weaponization of the SWIFT system is pushing middle powers toward alternative payment networks. This isn't just a temporary fix, it's a structural shift that could eventually test the dollar's global dominance. In the corporate sector, dividend data notes that Dell's 20% dividend raise marks a shift toward growth in AI-optimized hardware. Walmart is also seeing its valuation expand as high-margin digital advertising and memberships drive growth beyond its core retail business. Finally, Everything Money points to a contrarian view for Morningstar, suggesting that NVIDIA might be undervalued despite the recent 10% drop from its peak. Heading into the next session, we're monitoring three key signals. First, we're watching shipping traffic through the Strait of Hormuz. If that zero-flow environment persists, it remains a major risk for the S&P 500. Second, we're tracking AI credit spreads for signs of tightening in off-balance sheet debt. Third, we're looking for a pivot in the labor market. Benjamin Cowan notes that a technical correction doesn't always lead to a recession, so initial jobless claims remain a priority. Finally, for infrastructure exposure, dividend data highlights Comfort Systems, which is growing rapidly as a services provider for AI data centers. The market is moving past the AI hype toward the realities of credit and supply chains. Since headlines often lag behind the actual data, it pays to stay disciplined with your levels. You can find our full source list and claim IDs in the description. Thanks for watching, and good luck out there.